Talk Money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Global equity markets are in an interesting spot. Wall Street is trading around record highs, even as geopolitical concerns remain fairly persistent. Meanwhile, China is trying to push through another round of stimulus to revive consumption and to relieve stress in the property market in that country. Now, given all of these factors, there has been a lot of interest in the multiple avenues which are available for us here in India to invest in some of these global markets. And it's not just about timing the markets. It's a deeper question that we're trying to address today. Should we be taking exposure beyond Indian shores, beyond Indian stocks? Why should we look at it? What are the things to consider and what are the mistakes to avoid? So to discuss this, we have with us on the show today Dinesh Balachandran, Head of Equity at SBI Mutual Fund, as well as Nasser Salim, the Managing Partner at Flexi Capital. Gentlemen, thank you very much for joining in. So it's an interesting subject at hand because what happens is information can be very empowering. So now most of us retail investors are very well aware of why NVIDIA is rising, or which is the latest chip that Google is trying to invent, or what's happening in China for that matter. But the question is that at a deeper level, should we be looking at equity investment beyond India? First thoughts. Let me open with you, Dinesh.
Yeah, in my opinion, when I think about the advantages, disadvantages of investing in global markets, a couple of factors immediately come to my mind. One, when I think about Indian market is well diversified. You have good companies across sectors. From that perspective, we are actually in a lucky spot. But when I think about one area that is potentially missing in India, it is essentially good technology product companies. We have very few of them, definitely not in scale. And so that is one area where if I am thinking about the future, technology is an integral component of it. And when I think about the good technology product companies, they are all based out of India. And so right there, there is a reason to sort of think about investing outside India as opposed to just thinking about Indian companies. And the second aspect is when you think about valuations, there is definitely a big valuation differential between Indian companies and most of the global companies out there. In fact, there are many cases where you have the MNC parent of an Indian company that is effectively trading at close to free valuation or very throwaway valuation. That essentially tells you something about the valuation differential in India versus outside India. So that also makes a case for at least investing part of your money outside India, essentially.
Okay, that's interesting. So two major solid reasons why maybe you would want to look overseas. As Dinesh points out, that it could be because you're just not getting those kind of businesses here to invest in. And the second reason could be valuations, because maybe the global company, the global parent could be trading at a more attractive valuation than the Indian market, which ends up being, many a times fairly expensive. So let's ask our second guest as well. Nasser, great to have you, join in the conversation. And that's the real thing. There's information and there's noise, and there's plenty of both in the market today, thanks to the availability of, digital inputs. So what do you say when investors come and tell you that, oh, I want to own Apple and, I bought NVIDIA at a certain price and now I've made like 100% return this year? How do you navigate this question of buying global stocks?
So good morning, Surabhi. Thank you very much for having me back on your show. It's always a pleasure. So, to answer your question, I think we need to kind of understand what is the main reason for investing, in terms of other currencies and more importantly in other markets. I think the main point is diversification in this case. So I think the first and foremost is, Surabhi, is, when you look at international assets, we need to look at something called the hedge against the rupee depreciation, which is available for a lot of Indian investors and for several reasons, right? Historically, for example, Indian rupee has depreciated against, in specific example, the US dollar. Due to inflation differentials, trade deficits, and global economic factors. So when we are looking at portfolios, we need to see how do you kind of ensure that you have a hedge against your original currency, where you're investing money from. Number two, I think what my fellow panelists just said about diversification, which is in terms of better price to earning bands and multiples that you do get with certain, innovative markets, companies, world's largest and most innovative companies like example, Apple, Amazon, or Google. It does reduce dependency on Indian markets and mitigates country-specific risks. So that's another thing that we tell our, most our investors. The other thing, of course, is that, what different ideas can you capture as far as market opportunities are concerned? So it's access to global growth. Out of India, can you participate in something which in other economies relates to technology, financial advancements, which offers better growth opportunities unavailable in the Indian market context? And sectors such as, for example, technology, biotechnology, Surabhi, and clean energy are some of the other companies that are dominated, beyond the FANG list of companies that we just spoke about. Those are again something which do catch a lot of attraction. And my last very important point on this is, Surabhi, is portfolio stability. You see, there are many currency denominated assets which can stabilize portfolios during periods of high volatility in the current Indian markets, for example, or because of geopolitical uncertainty. So I think some of these are important factors that need to be considered for when you're looking at in the international opportunity.
Got it. Interesting thoughts there. Dinesh, do you agree that rupee point is an important one, right? And we as investors perhaps don't think about it. But what do you say? Now, the counter argument could be that if you have some sort of an expense coming up, a dollar expense coming up, say, someone in your family needs to move overseas for education. In that case, should you think of dollar investments? What if, you don't have that, but maybe you just take, one international holiday a year? Should you still look at dollar investments? Because we don't think, I don't think we think enough in terms of the currency diversification. Is that really required for the average investor?
I mean, when I think about the rupee volatility, that has definitely come down over the last 10 years, right? If you look at the volatility, let's say 20 years ago or 30 years ago, it was much higher. Of late, it's definitely been much more stable. So if someone is just thinking about making an overseas trip or some one-off sort of expense outside India, I don't think you need to sort of invest in global stocks to hedge that aspect. On the other hand, when you have something more meaningful, education is definitely a big expense. And from that perspective, sort of having a dollar investment as a hedge against the currency part of it, it sort of definitely makes sense. Overall, I would say that when you talk about equity investing, frankly speaking, currency, I would imagine, is a relatively minor component of it. Now, when you want to just sort of match assets against liabilities, yeah, it makes sense. But from a pure equity perspective, yeah, currency is a factor, no doubt about it. But particularly in terms of where the current sort of like structure, what the structure looks like, I would imagine that to be a relatively minor component in the overall equity investing framework.
Okay, fair enough, fair enough. So it depends on each individual investor's needs. The other question then is, I mean, I think both of you are in agreement that it is worthwhile to look at global markets when you have those specific investment objectives in mind. Now, the question is, how do you go about it? And we have two routes available, and we should tell our viewers this. There is a DIY approach where you can go and buy stocks directly, and you can do that because a lot of Indian brokers right now have links with foreign brokers, and then therefore you can pretty much convert your rupees into dollars or whatever is the investing currency, and then use the DIY broker route. The other route is simply going via Indian mutual funds. So which is perhaps more suitable to retail investors? Let's ask our panelists. Dinesh, comment on this. There's a bit of a flair in saying I own Apple directly, right? It comes with a bit of bragging rights, but why should or shouldn't you look at this route?
Look, I'm a mutual fund guy, so you know what my answer is going to be here. But apart from that, when I just think about the relative merits, pros and cons of direct investing versus mutual funds, there are few areas where I think mutual funds definitely score. Bragging right obviously is not one of those. But apart from that, there is an annual limit, right, of around $250,000 that an investor can sort of like use to invest in overseas stocks. So if an investor wants to sort of invest more than that, you can't do it with a DIY sort of approach. So there, mutual funds definitely help because they are pooling resources across investors. The need for a $250,000 cap at an individual investor level is not there. So if someone wants to sort of invest more than that, they can do it through mutual funds. The second aspect is, again, there is this very famous Peter Lynch adage, which says that invest in what you know. Normally, when you talk about domestic stocks, you still have a pretty good sense because you sort of have some sort of experience, exposure to these companies most of the time, right? But there are a lot of foreign stocks where you probably have very little exposure / experience with them. So then you need to do a lot more research if you want to adopt a DIY approach. And so then if there is a mutual fund that essentially does the job for you in terms of doing the requisite due diligence on these companies and also providing diversification across market cap, across sectors, and so on. That definitely sort of helps. So in my opinion, these two are two primary reasons why a mutual fund might score over a direct investing approach. But if someone really wants to put in the time and effort into figuring out what makes individual companies tick, they can do that as well.
Okay, fair enough. Nasser, same question to you. What would you prefer, going direct or looking at funds? The limitation is, we'll come to that in just a bit. The limitation is that not too many Indian mutual fund houses are right now accepting money in their global funds, and we will get to why and what the issues are. But your thoughts?
No, so Surabhi, clearly, I think as far as there is no best route available. It's subject to one's risk appetite and one's understanding of and knowledge and experience in investing. But clearly, there are opportunities such as direct investments which are available through, and there are many such platforms available now, Surabhi, on account of international brokerages like Interactive Brokers, there's Vested, there's StockAl, or Indian brokers have tied up with US tie-ups such as ICICI Direct and HDFC Securities. And those are best, exposure for blue chip stocks, growth stocks, and ETFs, and obviously subject to one's own research. International mutual funds remain, very much, subject to their limits that is available. Invest in mutual funds with underlying exposures to US equities or global indices, right? So examples such as Motilal Oswal, the Oswal Nasdaq 100 ETF, for example, or the Franklin US Opportunities Fund. These are international funds available for a lot of investors are seeking professional fund management and ease of investment in INR, right? And that is something which is available. As far as then there are ETFs also which is available. I think a lot of investors have the options of investing directly in exchange traded funds that track indices like the S&P 500 or Nasdaq 100, and these are broad market exposures at lower costs, which is an important point to be noted. And then the last two are feeder funds. The feeder funds, very popular. Are invest in feeder funds that invest in US-based mutual funds or ETFs. And it's for simplicity, it's based in INR-based transactions, low entry barrier, simplified taxation compared to direct US investments. So obviously, for people who have prior knowledge and experience, should be maybe direct route to US stocks subject to one's risk appetite, and all the disclaimers in place, full research being done. One can look at that. Otherwise, in our opinion, international mutual funds and feeder funds are very good opportunities available to investors in India, and they should make use of it.
Okay, all right, got it. Thanks very much. Just to complete this point, Nasser, I think you made a sort of emphatic case for looking at some of the mutual funds that are right now taking money. But just to complete that point, Dinesh, explain to us this whole business of limits, right? There is, I think, an industry-wide cap, a regulatory cap that SEBI has imposed. How do these caps work? And then which are the fund houses that can still take money? Because I think there are then some specific sub-limits for fund houses, for instance, which have ETFs or other passive products. So what is this regulatory issue? Why aren't all AMCs taking money in their global funds?
So more than 15 years ago, I think somewhere in 2007 or 2008, RBI essentially came out with this policy where they wanted to cap the overall amount that mutual funds can invest in overseas stocks. And this was based on thinking about currency volatility because they didn't want the domestic currency to be too volatile and other factors. So a overall limit of $8 billion was set for the industry. Within that, ETFs, there was a sub-limit of $1 billion for ETF. And then for the other mutual fund schemes, an overall industry-wide limit of $7 billion was the limit. And this was set more than 15 years ago. And that's been the level since then. We haven't actually revised that limit upwards over the last 15 years. So you have a $1 billion limit for ETFs and $7 billion for mutual funds, essentially. Now, within that, what also happened was that, let's assume, how do you figure out like whether a mutual fund is actually stepping over the limit or not? So then a few years ago, what they said was that because the overall industry was getting very close to the $7 billion limit for mutual funds, the regulator effectively said that whatever the current exposure is of an AMC with respect to foreign stocks, let's just cap that. So if an AMC has, let's assume, close to $1 billion exposure to overseas stocks, that limit will be the limit for that particular AMC, and it cannot go above that limit. So if it wants to invest in overseas stocks, it has to sell something first before buying that.
Got it, got it. So yeah, those are some of the intricacies and technicalities because of which it's not a very easy open door right now in terms of giving our money to asset managers, and then they can go on and take it to global markets. But anyway, we've established the fact that it's worthwhile to keep your ear to the ground and to look at the MF route when you do want to go global and look at funds that happen to take money. The question is, what happens to the cost of investing in this way? What are the markets you should look at, and how should you integrate this in your overall portfolio? We discuss this after the break.
Let's talk money.
Welcome back. This week we are discussing how you can look at global equity investing and perhaps consider the mutual fund route when you want to give your portfolio that little bit of global international flavor. Well, let's talk about the cost of this sort of an investment and how it perhaps contrasts with investing in Indian equities. We're in conversation with Dinesh Balachandran as well as Nasser Salim. Dinesh, so let's talk about the tax piece because that changed in the July 2024 budget, right? How is it different from, say, the taxation of regular diversified equity mutual funds, which are investing here in India?
Right. So when you talk about the domestic funds, the holding period is defined on the basis of so there is a short-term capital gains tax structure and a long-term capital gains tax structure. If the holding period of the investment is greater than 1 year, then it becomes long-term. If it is less than 1 year, it is short-term. That's the case for the domestic mutual funds. But when you're talking about global funds or the funds that are investing in international stocks, the holding period effectively is 2 years or 24 months. So if an investor is investing in a global fund and is going to redeem in less than 24 months, then the taxation that they face is essentially a marginal tax or their actual slab rate. That is the taxation structure for less than 24-month holding period. On the other hand, if the holding period is greater than 24 months, then it is essentially 12.5% without any indexation. Again, when you compare it with the domestic mutual funds, if it is less than 12 months or 1 year, it's 20%. And if it is greater than 1 year, there it's the same, it is 12.5%. So the holding period is different, and short-term capital gains tax rate is different depending on whether you're investing in a domestic mutual fund or a fund investing in global stocks.
Oh, okay, fair enough. So that's one element, that we have to factor in when we're looking at post-tax returns. So that's one piece. The other sort of piece is the expense ratio or the costs. And how do the costs of some of these funds, Dinesh, how do they compare and vary versus any normal flexi cap fund or a diversified fund here in India, where the expense ratio tends to be in a band?
Right. So when you talk about a fund of fund structure, so again, when we talk about mutual funds investing in overseas stocks, there are two structures. There are certain schemes that directly invest in global stocks, but most of the mutual funds have a FOF structure or a fund of fund structure, where they are effectively investing in a global fund, which in turn invests in individual stocks. Whenever you talk about a FOF structure, a fund of fund structure, there are essentially two layers of expenses involved. There is an expense involved at the global fund level that you're investing in, and then there is an expense that is involved at the FOF level, the fund of fund level. So from that perspective, you can sort of say that there are two layers of expenses here compared to only one layer of expense if you're investing in a fund that directly invests in specific stocks. But from a practical perspective, when I look at the combined expense ratio, I still feel that for the most part, they are in sort of a very similar band, maybe slightly higher for FF structure, but more or less, when I actually look at the combined expense ratio, it tends to be sort of similar to what we see out here as well.
Okay, so it's not like it's substantially higher or anything like that compared to diversified equity funds here in India. Got it. Nasser, so now coming to the point in terms of how to reasonably and rationally incorporate some of these global funds in our overall mutual fund portfolio, what is the recipe or the advice that you'd give?
Considering valuations, they're expensive currently in the US. can one look at a plan where you invest in something like the Russell 2000 index? That is something which has got reasonable valuation, and broad market indices have overperformed. Will sooner or later start to correct to be at more palatable levels. For example, the US equities and specifically Russell 2000 index. That's one opportunity that one can identify. Second is, we talk about markets such as Europe and Japan, from a broader international perspective. Now, the EU is experiencing gradual improvement, driven by easing inflation, will be robust employment and increasing real wages. Now, these factors may support or moderate a GDP growth and consumer spending from 2024 on.
Dinesh, of course, you look at all kinds of markets. You look at, in fact, different asset classes as well. So now you can perhaps wear the fund manager's hat and tell us for not just 2025, say for the next 3 years, if I want to add 5-10% of a global market flavor in my portfolio, then which are the markets that I should look at and not worry? We don't want to lose too much sleep over these kind of investments, right?
Yeah, particularly when you talk about long-term horizons, right? The number one factor to think about is the growth runway. Valuations obviously matter, but as you increase the time horizon, the importance slightly diminishes. When I think about growth runway, I think nothing beats some of these US companies because the kind of spending that they do on R&D, no one else comes even close. And I'm not even just talking about the Max 7, the NVIDIAs of the world. Even like small biotech companies or even small companies in other sectors. There are very innovative companies that do a lot of spending on R&D, and that ensures a long growth runway. So whenever you think about a long time horizon, you do want to invest in these companies that are essentially leveraging R&D spends to build competitive advantage and essentially have a long growth runway. So that definitely has to be a part of the equation. Apart from that, when I just wear the valuation hat, obviously China looks good from a tactical perspective at least, because the valuations are definitely cheaper there. And more importantly, what is happening is that there is a renewed focus by the local government to boost consumption. And that augurs well for Chinese stocks. And so purely from a tactical lens, I think it makes sense to look at China. And I can say the same for Japan, where the argument is really more currency depreciation and what that does for Japanese companies focused on exports. So even that can be an interesting tactical opportunity. But if I have to just think about long-term time horizon, I still would place my bets on good companies based out of US that essentially are doing a fantastic job on the R&D spend side.
Okay, so US, China, and Japan, 3 big markets that our experts feel that you may want to study further and then take a call in terms of your investments. Thank you very much, both Nasser as well as Dinesh, for joining us on the show. These are interesting thoughts and interesting sort of international aspects that we can perhaps consider when it comes to our mutual fund investments. Well, with that, we're out of time. It's a wrap on this week's show. Thank you very much for tuning in. We'll see you with another theme next week.
Let's talk money